Welcome, everybody. Thank you for attending. Thank you for your patience, and my apologies once again for technical screw-up. This is Randall, Liss. We're going to be talking about three-dimensional option trading. Before we do that, I'm going to say just a very little about myself for those who don't know me. So, my name's Randall Liss. I have my own education website, www.thelissreport.com. I encourage all of you to take a look at it, subscribe to the blog. Subscription to the blog is free, and I write every business day. Now, I helped start the European Options Exchange in Amsterdam in 1978 after working on the CBO. After working for the exchange to help get it going for a couple of years, I became a market maker. And I was a market maker on that floor, trading for my own risk and reward until the exchange went screen-based in 2002. For myself, I didn't enjoy screen trading nearly as much as I enjoyed yelling and screaming on the floor. So I became an options educator, transferring the knowledge I've built up over the years. In 2008, for personal reasons, more or less, I came back to Chicago. And I've been in Chicago ever since. And I have my own, as I say, options education biz. I am doing this webinar in conjunction with MrTopStep, who I'm sure all of you are familiar. If you're not, please do, because they're worth getting to know. I've gotten to know them, and they're serious professional people. So we're going to talk now about three-dimensional option trading. Before I get into exactly what that is, I have to say a couple things, and this includes a disclaimer. First of all, you are not going to get investment advice from me, ever. I'm not going to tell you what to buy. I'm not going to tell you what to sell. I don't know what to buy or sell. I know options. My purpose is to help you translate your vision on a stock or an underlying value into a sound risk-reward option strategy. That's what I do. I'm not a financial advisor. I'm a financial educator. Next, when you're listening to me, it's very important to bear this in mind. I assume you can all see the slide here. Assume a frictionless market. If you can't, please let me know. What do I mean by a frictionless market? When I talk about these things in all my lessons, not just this one, in all of them, I take no account of commissions. I have no idea who your broker is. I have no idea of your commission structure. So I take no account of it. I assume liquidity. I strongly recommend, by the way, that you only trade products that are extremely liquid. And along those lines, remember, ease of exit is more important than ease of entry. It's more important to be able to get out of a position than get into a position. So I assume liquidity, and I hope that you out there only trade liquid products. I take no account of tax consequences. I have no way of knowing your tax bracket. I don't know if what you're doing is short-term capital gains, long, whatever. I don't bother. I actually don't know that much about taxes. I don't allow for the bid-offer spread. Once again, this goes back to liquidity. I like a very narrow bid-offer spread, preferably minimum tick. But in my lessons, I don't account for it. And I assume a near zero interest rate, which I know is not true for everyone. But in my calculations and illustrations, I assume that money may be borrowed and lent at the exact same rate. That's what I mean by a frictionless market. Not only in this lesson, but all my lessons, I assume a frictionless market. Important to remember. So what are we talking about here today? We're talking about looking at options in three dimensions. Three-dimensional option trading. Here's an old quote from 1909, 105, 106 years ago. It's often easier to tell what will happen to the price of a stock rather than how much time will elapse. That's an ancient truth. and it holds to this day. I'll give you a couple examples of something that pretty much everybody knows is going to happen, but opinions vary on when. The stock market is going to have another one of its 8 to 10% downdrafts. It just does. It's the natural course of things. It's actually good for a bull market to pull back a little bit. So everybody knows that the market's going to drop 8 to 10% one day. But when is that day? Is it going to be before the new year? Are we going to have a big New Year's rally, then followed by a sell-off? Or maybe the New Year's rally doesn't materialize? Okay, what is my definition of liquidity? My definition of liquidity is that the size of the bid and offer is a minimum of 100, and the spread distance is as close to minimum tick as possible, to answer Philip K's question. Liquidity, I want to see at least 100 on each side of the bid and offer. I want to see a good open interest. Very important. I discuss open interest in great length in other lectures. I want to see large open interest. Don't trade option series that don't have a large open interest. And if you want numbers, never have a position that's more than 1% of the open interest. And I want my spread between bid and offer to be as close to minimum tick as possible. Liquidity, bid-offer spread, size of open interest are key determinants in deciding what products to trade. So, anyway, we all know this 8 to 10% correction is going to happen one of these days. But it's when it's going to affect your investment strategy. I'll give you another example. Interest rates are as close to zero as makes no difference. Everybody knows the Fed eventually is going to normalize interest rates, as will the ECB. Certainly, if unemployment figures continue to improve, it will happen, but nobody knows when. A lot of people say the course of 2015. A lot of people say, no, it'll take longer than that. But it's another example of something everybody knows is going to happen. But timing is everything. Now, when I speak to my new students, or people come to me because they're frustrated with their trading and they're losing money, the single biggest complaint I get goes along the lines of this. I thought the stock was going higher. I bought the calls, the stock went higher, but I lost money. How did that happen? That's because only one dimension was considered, the dimension of direction, up. But you need to consider 3 dimensions, and we're going to go into these dimensions in this session today. Those 3 dimensions are direction, time, velocity. You can look at direction as the what, you can look at time as the when, and you can look at velocity as the how fast, the speed. You must consider all 3 dimensions to be a successful trader. As I've said, direction is often easy. Now, direction also can mean the lack thereof. Stocks and indices not only go up or down, they often go sideways, sometimes for a great length of time. So when you say what direction, it's not just up or down. Maybe your opinion is we're going to be range bound. We've had a big move, we're going to settle down, we're going to be range bound. Sideways is also a direction. It's also part of the what. Up, down, and sideways. So direction is your first consideration. But to go back to the complaint, my most common complaint that I hear, I bought calls, the stock went higher, and I lost money. That's because the person probably just bought the calls outright, meaning just naked calls, bought them. I'm not an advocate of trading options outright. I'm an advocate of spreading options. In other words, for options that you buy, you also sell other options. So I'm an option spreader by training and discipline. And in many other lessons, I go into that. I don't like buying options outright simply because the clock is so much against you. The clock is so much your enemy. Tick, tick, tick. Don't forget, time decay happens while you're sleeping. Time decay happens at night and on the weekends as well. So you better be right, and you better be right fast if you're going to buy options outright. Now, I don't like selling options outright just because I don't like unlimited risk. You will never see me teach a strategy where the risk is unlimited. Matter of fact, I counsel my students and mentees, when you figure out your maximum profit, your maximum loss, and your break even, if the maximum loss is unlimited, I say don't do the trade. All right, so that's the what. Up, down, or sideways. Not just up or down. Up, down, or sideways. Let's talk about when. And not just when, but how long. Duration is a part of time. For instance, is the move going to materialize overnight, or is it going to build up and take a while? Will the move be a pre- or post-event move? If, for instance, if you foresee something will happen before an event, say an earnings announcement or an unemployment figure, and you think, you know what, the market's too complacent, conventional wisdom is too vulnerable here, I think we're going to get a move post-event or pre-event. If you think the move is short-term, if you think the move is going to happen sooner or later, then I would use short-term options. Let me qualify a little bit what I mean by using short-term options, however. Now, here's where I differ from a lot of my colleagues. I'm not a big fan of the weeklies. If you want to trade the weeklies, you know, go ahead, it's your money. But you probably should look to someone else for your education. I know a lot of people say the weeklies are consistent income and la-da-da. Well, I don't believe that. I believe that the weeklies don't have enough time to have any decent premium. And I believe, in fact, the weeklies are 4-day options because I don't think the retail trader should be trading on expiration day. There's too many games the pros play. So when I talk about short-term options, I mean your plain vanilla options that expire on the 3rd Friday of the month. I like to have at least 3 weeks to go before I put on a position. This is for a few reasons. First of all, you get a lot of mean reversion. The pendulum swings one way and then swings back the other. The weeklies, for instance, don't give enough time for the pendulum to swing back. So you might have to adjust or take a loss before you otherwise would have had to. So I like there to be 3 weeks minimum in my option strategies. I saw Philip did ask a question there. Please feel free to jump in with any questions you like. Short-term moves, short-term options. If you think something's going to happen way down the line, well, then I would say use a longer-term option, a 2-month or even a 3-month. But once again, watch out for the liquidity trap. The further long-dated the options are, very often they're less liquid, with a smaller open interest and a wider bid-offer spread. Here's some examples. Let's say you have a high level of conviction that, I don't know, XYZ is at 85, headed for 100. I would be looking to buy the 90-100 vertical call spread. This is what I mean. Don't just buy the 90 call. Do the 90-100 vertical spread as an example. Yes, it captures upside. Yes. You can't make any more money after the thing goes above 100, but okay. It also drastically reduces your downside risk. This is what I mean by spreading. Here's another tip for you. Here's another mistake that rookie traders make. If you think XYZ is going to 100, it might sound counterintuitive, but you want to be short the 100 call, not long the 100 call. Because the 100 call is still worthless with a stock at 100. Option positions make the most money when expiration is on your short strike, and they lose money when expiration is on your long strike. So if I have a high level of conviction that XYZ is going up, say it's 85 going to 100, I'm looking to buy a vertical call spread. Let's say I have a lower level of conviction. I think, yes, the underlying value is going higher or lower, but I really don't want to bet the ranch and just be mega long or mega short. I would be looking to do an out-of-the-money butterfly, be it put, be it call. This brings me to another point. The difficulty in doing things like I'm doing now is I have really no way of knowing what the audience option knowledge is. And it's a real trap. It's difficult pedagogy. Because if I talk too basically for everybody who knows everything already, or knows a lot already, people will get bored and tune out. And if I talk over the heads of people who don't know enough, people will get bored and tune out. So when I say an out-of-the-money butterfly, for this lecture, I'm assuming that everyone out there knows what that is. If you don't, well, then that's a subject for another class. I have a question here, 3 weeks minimum. What's the best time duration for trading? 2 to 3 weeks, in my view. 2 weeks, probably. So anyway, back to what I was saying. If I have a lower level of conviction, I'm looking to do an out-of-the-money butterfly. Excuse me. And once again, the short middle, not the long wings, but the short middle strike of my butterfly is my price target, because I want expiration to be on my short strike. Now, there's lots of rules about trading butterflies, and that's a whole other lesson in itself. The wings must be equidistant, don't pay more than 10% of the strike differential, etc. But we're going to have to leave that to one side. That's not the subject of today's talk. Today's talk is, by and large, a Get Acquainted with Randall show, so you can get a feel for what I and MrTopStep will have to offer you. So if I'm talking above your options knowledge and you don't know what a butterfly is, I apologize. And if I talk under your option knowledge, where of course I know what a butterfly is, you idiot, I apologize for that too. So if I have a lower level of conviction, I'm looking to set up a butterfly around my price target, be that put or be that call. Now let's say I think the underlying value is going to drift. That the underlying value is going to drift. Then I'm thinking to use a collar. A collar is long the underlying value, long the out-of-the-money put, short the out-of-the-money call. So you collar your stock or index. If I think we're going to move sideways, there are also some good range-bound trades we can consider. The condor, the iron condor, and the iron butterfly. I have a question here. Always hear folks buying deep in the money options. Well, go ahead. I think it's foolish. I think you have no hedge. You better be right. I mean, if you're buying deep in the money options, what, just for leverage? Why not buy the future of the stock? you want to buy deep in the money options, well, at least spread them out somehow. I'm not a big fan of just buying deep in the monies, be they puts, be they calls. I'm a spreader. To answer, I hope that answers Brett's question. Excuse me. Now, the third dimension, we talked about two dimensions. We talked, first dimension is direction. The what. The second dimension is time, and that's the when. And the third dimension is velocity, the how fast. For instance, this long storied 8 to 10% correction that pretty much all of us believe is inevitable, although we don't know when, is this correction going to be sudden? Is the black swan going to fly again? There's going to be some shock, and we wake up in the morning and the market's down 8%? Or is it going to be sort of a drip, 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 death of 1,000 cuts kind of thing, where it goes sideways, but just trending lower, lower, lower till it finds support? Velocity, is it going to be a gap, or is it going to be a slow grind? Now, this is very, very important, because this depends on if you're a premium buyer or a premium seller. A strong move will increase implied volatility. A strong down move will explode implied volatility. In October, when I think the last time we had our, a basic 8%er, the VIX, the measure of implied volatility on the CBOE, went from 15 to 31. So implied volatility more than doubled. A move up, even a strong move up, tends to crush implied volatility. There's lots of reasons for this. I'll just give you one of them, the human reason. I believe that there's only two things that move the market. It's not fundamental analysis. It's not technical analysis. The two things that move the market, any market, are greed and fear. Greed takes the market higher. Fear takes the market lower. I look at out-of-the-money calls as an expression of greed, and out-of-the-money puts as an expression of fear. And of the two emotions, fear is stronger than greed. This is why premiums, particularly puts, will explode on a down move and get crushed on an up move. When people are greedy, they're complacent. And when they're scared, they're nervous. Harry K. asks, is it true that 90% of options expire worthless? I don't know if it's exactly 90%, but yes. The answer to that is absolutely so. Every expiration, far more options expire worthless than end up turning into the underlying value through exercise or assignment. So you really need to consider how fast this move is going to happen. Now, a part of let me give you an example. Before I go on to something else, let's talk a couple examples. When I say IV here on this slide, IV is implied volatility. Remember that there are two sorts of volatilities when we measure volatility in the marketplace. There's historical and there's implied. Historical volatility is very simple. You're looking backwards. What was the volatility in the underlying value during the time in question? Implied volatility, on the other hand, is what the market thinks the volatility will be. think of the at-the-money straddle as a pure expression of implied volatility. If I can call up my pen, I will show you. For instance, with the stock at 100, we know that the straddle is the combination of the call and the put, correct? Buy both, sell both. Let's say, let's say with the stock at 100, let's say the at-the-money straddle, the 100 straddle, is trading at 10. Let's say it's 520 in the put, 480 in the call. You know, the problem with this, not just on Novia, I use GoToMeeting.com in my private lessons. The drawing tools look like my grandson is doing it. Love it if one of these things got a good drawing tool up there. Anyway, if the at-the-money straddle is trading at 10, the market, in its wisdom of supply and demand, believes that there's going to be a 10% move. We're going to go under 90 or over 110. That's what the market is saying. If the at-the-money straddle is trading at 8, then the market believes there'll be an 8% move and so on. It was trading at 12. So implied volatility is what the market, in its wisdom of supply and demand, thinks the coming volatility will be. So if implied volatility explodes, you can still be wrong, but make money or lose less. Let me give you an example. A favorite strategy of mine, if I think a mega up move is coming, for whatever reason, we've been beaten down too long, takeover rumors, I like the bullish backspread, in which I'm long 10 out of the money calls, but against that, because I'm a spreader, I sell one in the money call, preferably for even money or even a slight credit. And let's say I'm wronger than wrong. We don't explode higher, we puke. Well, the explosion in implied volatility will keep those calls steadier. The calls will go down sticky. Whereas your in the money option, you're short, will go down dime for dime with the underlying value. So the stock crashes or the index crashes, but the explosion in implied volatility keeps the calls steady. I hope that's clear to everybody. If it's not, let me know. Here's something else about historical volatility versus implied volatility I'd like to talk about, because it's important to contrast the two. Implied volatility has a strong tendency over time to revert to the historical mean. This is particularly true when implied volatility is under historical volatility. Now, you can look at the historical volatility. Any decent trading platform has it. You could even calculate it yourself if you wanted to. So you look at your historical volatility and you look at your implied volatility, and this helps you decide, am I going to be a premium buyer, or a premium seller? If implied volatility is under the historical volatility, I'm very likely going to be an option premium buyer because of the tendency of mean reversion. That is also true if the implied volatility is over the historical volatility, but it is less true. If you see an underlying asset where the option implied volatility is under the historical volatility, it's a real opportunity for you. The options market tells you so much just by the prices out there. You don't have to try and outthink it. I mean, that's the mistake a lot of people make. They try to outthink the market. Well, it's really quite simple. And the options market gives you information every day. Open interest tends to tell you where the market thinks expiration will be. The at-the-money straddle tells you what the market thinks the trading range will be. Implied volatility tells you what it thinks the volatility will be in relation to historical volatility. So if you see an underlying asset where the implied volatility is under the historical volatility, that very often gives you a wonderful trading opportunity. Like anything else, the more you put into this game, the more you get out of it. Implied volatility has a very strong tendency to revert to the historical mean. Now, here's something else. You can have it both ways. For instance, let's say you think a move is coming down the road, but not quite yet. Well, time spreads, also known as calendar spreads, are a great way to trade both directions. You want the short leg of your spread to expire worthless, and this will help offset to a great extent your long leg. Now, here's a real-life example of more than a year ago. Oddly enough, I've taught this lesson before. Remember, I'm not showing you exact trades, so it doesn't matter that this trade is outdated. Any trade I showed you would be outdated. The market's closed. What I'm trying to do here is help give you a way to think about options. Another way of thinking about them that you don't find other places. Hence, 3 dimensions. I don't see a lot of people out there talking about 3-dimensional option trading. So when I use these examples, these are real-life examples. When I took these off the screen, these were the prices. But I'm not putting this there for you to replicate it. I'm giving this as a way for you to think about it. The premise at that time was that Apple would drift along and then explode at the end of the year. What you could have done was sold the November 550 call at 950 and bought the December 570 call at 10. If your premise was correct and Apple finished below 550 on November, you have the December 570 call for only 50 cents and not 10. Now, because the strikes are different in this example, we call this a diagonal calendar spread. Time, by the way, is a wonderful thing to trade. I really, really, really recommend looking at calendar spreads. You're not going to get rich overnight. It's not a win the lottery trade, but it has a very good risk-reward ratio, and it's a good way of chipping away. To use a baseball analogy, I believe in on-base percentage. I believe in Moneyball. I don't swing for the fences. I don't want to be someone with a lot of home runs and a lot of strikeouts. I want to chip away. I want to get on base. So calendar spreads are a great way to do this. Look at this example. You know, very likely that December 570 call was trading higher than 50 cents. There was your profit right there. Or you sell the December 590 call against it and turn it into a vertical spread. The point being the sort of first this, then that scenario. First, Apple will drift, then Apple will explode. So I do this trade, and I don't end up buying the December 570 call at 10. I ended up buying it at 50 cents. Okay, let's look at another example. using the SPY, that is the Standard & Poor's 500 exchange-traded funds. Now, while I am not a big fan of ETFs, particularly all that long, triple short stuff, which I really advise you stay away from, the SPY is a good ETF. It's better than the SPX, which the institutional traders use. Why is the SPY a better ETF? A better vehicle for you? Well, it's a tenth the size. It's super liquid. The markets are almost always minimum tick. So as long as you don't carry the thing exactly to expiration, because it is an American-style option, not forget, and will settle into physical delivery and not cash, as long as you're out by expiration, I think the SPY is the trading vehicle for the market as a whole for the at-home trader. Now, on that same day, over a year ago, my premise was that the market would rally slightly, but then we wouldn't have a January rally, we would have a January puke. So what did I do? I sold the November 175 put at $1.50. I bought the Jan 165 put at $1.50. In trader parlance, we call this doing the trade for even money. As long as SPY was above 175 in November, my January put was free. Just like the Dire Straits song, almost. The money for nothing and the options for free. I don't care if you're bullish or bearish, everybody likes free options. And in fact, yes, we did get a rally. So my Jan 165 put didn't make any money, but it didn't matter. It didn't cost me any money either. These are, again, are the sort of trades to look at. Low risk, high reward trades. You don't have to be super directional. I mean, if you're the super direction champ and don't need 3 dimensions, just need the what, well, heck then, just buy or sell the future. Philip K. asks, what's the risk for that trade? The risk, you can't exactly quantify. The risk is that the Nov 175 put goes in the money. And you don't want, unless you have the capital for it, you don't want to be assigned on your short Nov 175 put. Although even if you are, it's not actually that bad because you're long the 165 put against it. So even that, it's not that bad a trade. Your risk is minimal. Fighting off a cold, so my excuses for all the sniffling and snuffling. So I'm going to start to wrap things up, and I'm going to go over a couple other things with you, or answer questions. So remember, what is easy? What is direction? And remember, direction has 3 parts. Direction is not just up or down. Direction is also sideways. And you need to know, well, to have an opinion on, you don't have to know it, to have an opinion on the when. When is this thing going to happen? Is it going to happen tomorrow? Is it going to happen in the new year? When? And you also need the 3rd dimension. The 3rd dimension is velocity. Is this move going to happen overnight? Is it going to drip, drip, drip? How fast is it going to happen? Now, you can do different option strategies depending on all 3 of these dimensions, and I've showed you a few of them. In January, as soon as we settle down the exact day, in conjunction with MrTopStep, I'm going to be doing a daily options room. And the options room is going to be along the lines of the Ask Randall show. You, the subscriber, can come to me publicly or privately and say, this is my scenario. And I will suggest 2 or 3 option strategies at different levels of risk to help translate that strategy. I'm not going to say, no, your strategy's wrong. I'm not going to argue with you about it. I'm going to say, fine, this is your viewpoint. Let's look at it 3-dimensionally, and here's strategies for you. So remember, you must consider all 3 dimensions when you trade options. If you only consider one of them, it makes it awfully hard to lose money unless you're a lot savvier than me. Well, I do apologize for the technical difficulties right at the beginning. As soon as we know more about the exact option room, you will have that information. I assume you're on our mailing list. And if anyone has any questions, I would be happy to answer them. Matter of fact, you don't even have to keep the questions specifically to 3-dimensional option trading if you don't want to. I'd be happy just to, for the next 5 or 10 minutes, tell you what I think about the options market. Oh, is there any way to get to this presentation? John! Yes, there is. A recast we mailed to everybody. Okay. When premiums exploded, no, I don't wait a few days to answer that question. If I can find it here again. Where is it? When premiums explode and the market seems to be changing direction. Well, that is very often so. When the puts explode, it's very often a sign that at least a short-term bottom has been reached. Here's another thing. Here's another, as I talked about before, the market tells you wonderful things just in and of itself. Out-of-the-money puts almost universally trade higher than out-of-the-money calls. This is because, as I said, greed is stronger than fear. Also, there's a natural imbalance of put buyers because people are buying downside insurance. Just like there's a natural imbalance of call sellers because you have all the covered writers out there. So well and good. The difference between out-of-the-money puts and out-of-the-money calls is called the skew, but that's a whole lecture in itself. The point I want to make here is when the out-of-the-money put is very, very close to the price of the out-of-the-money call, it suggests complacency. It suggests that everyone is underinsured. So watch out. Conversely, when the out-of-the-money put is 3 or 4 times the price of the out-of-the-money call, it suggests that fear is rampant and nobody thinks we're ever going higher again, and that's often the sign of a bottom. The market tells you things. It's a great, great tea leaf. Open interest, the straddle, the skew, implied volatility versus historical volatility, is all valuable information. Are there any other questions today? Once again, my website is www.thelissreport.com. I write about this stuff every day. Subscribing to my blog is free. If you want individual lessons, and all my individual lessons are tailor-made to that individual. They're all an hour in length. I use GoToMeeting.com. I will give a free 1-hour trial lesson to anyone who wants one to see if you think you can learn something. If your home or office is in the Chicago area, I'll come to you. Otherwise, as I say, I do it virtually through GoToMeeting.com, and I'm extraordinarily flexible. With MrTopStep, the options room will be coming shortly. Be more or less the Ask Randall show. Just don't ask Randall if we're going up or down, because Randall doesn't know. Randall knows how to translate your view into a solid risk-reward option strategy.